Hello, this is Wes Bridle, and this is another Kingdom Calling Economic Update video. We are talking about gold and silver. This is our third installment, and to wrap up just what's been going on in gold and silver over the last few months. All of these videos are updates to the coming storm video, where I told you big picture what's going to be happening in our economy and in the world. If you go back, that video was made 2 years ago, but if you go back and watch it, you'll see a lot of the things that I predicted on there have happened already, but the really big things that you need to be preparing yourself for, they're almost here, and you just need to kind of know what's going on in order to not be blindsided by it. So I really recommend you watch that video if you haven't. Okay, the CME, which they're basically in charge of the gold's, all the commodity markets, and we're talking about gold and silver right now. They get to basically regulate what's going on in there. They should be on the side of the people, you'd think, and the government has kind of allowed them, the CFTC has kind of allowed them to self-regulate, and so you would think they're on the side of the people, and they should, you would think as an exchange they shouldn't really care. They shouldn't have favorites because everyone trades on their exchange, but in reality the bullion banks make so many more trades than anyone else, than all the rest of the market, and so they are by far their favorite customers. And so what we see here is that they changed margin requirements in the past couple of months. They've done this multiple times. At one point they changed it 2 days after silver declined 22%, they increased margin requirements. Typically, margin requirements are increased when the price is rising in order to steady the market, take the froth out of the market. It makes absolutely no rational sense why it would be done after the price has dropped substantially, unless they're just trying to hurt the people that are long and help the people that are short. Well, since their biggest customers are short, they're clearly trying to help them out. Now, I've been talking a lot about the manipulation. In the short term, it has a lot of effect. However, that shouldn't worry you and make you throw your hands up about these markets. In the long run, they cannot control the price. If you look over the last 10 years, they've been manipulating the whole time. The price has been going up dramatically. Hasn't been going up, as we showed, the same way that the money supply is going up. But so it hasn't kept up as much as it should, but it's still gone up dramatically. And the more it goes up, the more pressure they're under, and eventually they're going to capitulate and the price is going to absolutely skyrocket. I have no idea if that's going to happen in the next year or a few years away, but there's no question it's going to be happening. So I don't really mind it. There's a lot of people, Ted Butler is always getting people to write the CFTC and complain and all this. I don't really care. It's going to happen. Whenever it happens, it's going to happen. You just need to be on the right side of that when it does happen. Okay, in September prices plummeted, but the U.S. Mint, which also China, India, showed record sales. I had a point about this in a previous video. There's another indication. How do we have record sales when the price is dropping? That doesn't make normal sense. Economics 101, supply and demand. If the price is dropping, that should mean there's less people wanting to buy. Yet we see with everywhere we can get a solid number, a true number, we see actually buying going way up. So it shows there's a very big difference between the paper market and the physical market. Again, if you own paper gold and silver, you better be awfully sure that you own the right kind, because there's some kinds I would never own, because I don't believe they, in the end, are going to have the gold and silver they're supposed to have, and that's all going to come to a head at some point, and a lot of people are going to be very disappointed that they don't really own what they thought they owned. Eric Sprott calls for silver miners to hold 25% of cash in silver, which if they would do this, they would actually account for buying 10% of the inventory or the investment supply that's out there, which would cause obviously JP Morgan some serious headaches. This would be a profound thing, and it sounds like several of them are really thinking about doing this, which makes sense. If you're an investor and if you want to invest in a silver company, it's because you think the price of silver is going up, and you probably don't feel real good about the fiat money that you hold. So it's kind of silly to be these silver investors are making record profits, and they're holding their profits in cash, US dollar or whatever currency, fiat currency cash, That doesn't make any sense. So it's a good, of course they have to hold some for normal business operations, but it makes a lot of sense that they would hold silver. So that's a really interesting development to watch. If they actually do put that into practice, it will have a dramatic effect on the price, and apparently a lot of them are seriously considering it. Big price drops in gold and silver consistently engineered at the worst time to sell. I think I covered this in the previous, I think in the first video. If you're a big seller, you wouldn't sell when there's no buyers at the market. You would sell when there's lots of buyers. Someone is going out in the market and selling when there's no one around to buy, which engineers the worst possible price for them as the seller and has the side effect of dropping the market much lower. Wonder why. And the government reports show the big bullion banks who then buy after they've scared everyone into selling. So it doesn't make any sense. Buying low, selling high part makes sense, but buying at the worst price, buying low or selling low doesn't really make sense. AngloGold Ashanti has reported that large buyers of gold have approached them directly because they can't find physical gold in the market. So they're wanting to buy on the futures exchanges, but I guess they're trying to, those exchanges are trying to get them to accept paper money instead, even though it's supposed to be a physical exchange. And so they're going directly to the miner and saying, hey, can we buy from you because we can't get all the gold that we want. So another serious indication that there's a massive disconnect between the paper market and the physical market. Okay, Japan offering gold coins to persuade people to buy their paper bonds. This is quite funny. I guess Japan's now starting to struggle. They've got the same problem with the age of their society where they've kind of passed the bubble, and more retirees are collecting money instead of saving money. And so they have the biggest debt per capita of anybody, and so they're having serious problems. Who wants to buy Japanese paper pays no interest, so they're now offering small gold coins if you buy their paper. So that's pretty ironic. Money going into silver has been about 1-to-1 with gold. So again, the price of gold is 50 times higher than the price of silver, but the money going into them in the market is 1-to-1. So that shows you, again, a big disconnect on the price, and that silver, the price can't stay that low for that long with that much money coming into silver. SLV short has grown huge. So it used to be the shorting was just done on the futures market, but they've taken to shorting SLV, which is the giant silver ETF, as a way to push the price down. And what that also means, that the last number I saw was 7% held short, that there's 7% of the fund that absolutely does not have the silver in the vault to back it up, because if you short that ETF, you do not have to give up silver in order to short it. And so there's 7% that absolutely does not have silver in the vault. It might be more than that, but at the very least there's 7%. So again, that makes it dangerous to own that. Lease rate for gold is negative, so banks are paying money to lease gold into the market. Instead of, normally when you lease something you get paid for doing that. Traditionally, if you lease gold out, they pay you some interest for doing that. Well, today that rate, so many people or central banks are wanting to lease out that gold, and it could be some private banks doing it as well to raise cash, or probably primarily central banks wanting to hold the price of gold, silver down. They're leasing that out. The price, they're having to pay money to lease it out. It shows you the demand for that. Okay, I think that's it for this. I'm moving away from gold and silver on the next video. Looks like it's going to be on world economic events. Again, if you haven't watched The Coming Storm, I highly recommend it. There's a link to do that for free. Thank you for watching.